I'm Chris Preston.
I'm Brad Zimmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. We've fully recovered from last week's episode. I filed my grievance against Madison to our bosses, and we're raring to go. Happy holidays, everyone. We have a big show today. This is our last of 2024. There will be no show next week. So we'll see you again in the new year after this one. But lots going on in the market now. So let's get right to it. Brad, tell people what we're going to talk about today.
Yeah, this week's going to be a little bit less of a formal big three because it's all market related. We saw the Dow have 10 days straight of 10 losing days straight. We saw the S&P shed 3%, fifth biggest point based or fifth biggest decline based on points alone. And then obviously the Fed meeting was sort of a catalyst in the middle there. And then we're going to talk to Steve Reitmeister of WallStreetZen after that.
And yeah, let's get right to the market stuff. It's been an eventful, volatile week for the market. We'd been talking for weeks, saying that, and not just us, other Cabot analysts, that there are some signs underneath the surface of the market, big, if not red flags, yellow flags, that there might be a bit of a correction coming. We thought it might be in January, but the Fed loves to, really just accelerate the selling when there's sellers out there, and that they did on Wednesday. Now, Jerome Powell, they did cut 25 basis points as expected, but they signaled slower cuts than I guess people in the market expected. At one point, people were expecting four rate cuts for next year. Now according to their dot plot, the Fed's dot plot signaling maybe two next year, just 50 total basis points. So the market didn't like that, sold off on Wednesday. It's bouncing back so far today, but the S&P, Nasdaq are now down more than 3% from their highs. And that follows, like you said, the Dow, its longest losing streak in 50 years, 10 days. Now, it's still only down just over 5% from its December 4th high. Um, and that's with today's, rally. The Russell 2000 small caps down about 8% from its late November highs. Equal weight index about 6%. So we're in a bit of a correct. It's not officially a correction, but we're in, a sell-off, and what was happening underneath the surface of the market has spilled into the major indexes. What are you seeing, and do you think the worst is over, Brad?
I, all right. I took my bear hat off last week, and I
Yeah.
believe I said the words when the last bear throws in the towel. That's when the correction hits. And I
Yep.
was prescient, but on the wrong side of it, I guess. I don't know. Um, well, okay, so I think the equal weight thing, tying it specifically to the Dow, right? Like of the major indices, the Dow has the most diverse exposure because it's supposed to be representative of the broader economy.
Right.
So equal weight declining and then small caps as an asset class declining, we're seeing sort of selling across broad segments of the market, but it's not necessarily hitting like the Magnificent Seven, right? Like that Apple's up 9% in the last month, Google's up 9% in the last month, Nvidia's off a little bit. Um, so I and the other thing, like with the Dow, I don't know how much weight to give to the situation with United Health. That obviously is a Dow member. They've lost more than 20%
Yeah.
in like the last week, or not in the last week, in the last let's say in December. Um, I guess, if I was expecting profit taking, that's not, I wouldn't have expected it to be people pulling back in and then staying largely invested in tech, right? It seems like some of the more speculative risk on stuff has pulled back more. Bitcoin has come down below 100,000, although it may be back up over that as we record right now. Um, Small caps, right? They're more risk on. They've pulled back. So it seems like a strange place for profit taking. It does feel like if like it's maybe getting a little bit more risk off. Um,
Yeah. And volatility, we talked about how low volatility has been for months. As we sat here recording at this time a week ago, the VIX was at 13.8 and exactly doubled by the time, Jerome Powell finished speaking, basically up above 27. Um, and it's since dipped. It's pulled back a lot. It's down below 20 now as we speak. But it's pretty clear that, like you said, it's become more risk off, at least in the last couple weeks. And what Powell said, whether it should be treated, as some sort of disaster, is up for debate. But um, it certainly, people who are on the ledge, ready to jump, he gave them a big shove in the back. And volatility is back.
well, and one thing that you asked that I didn't really address, but I think we should is, what maybe we would be looking at going forward. As of right now, I just pulled up a chart of the S&P. We're back up above the 50-day moving average. We closed the gap up from the election effectively. It had gapped down, at the very end of October and then gapped up to sort of close that gap. Uh, it's not that dissimilar from what we saw in August, September, that sort of time frame where it briefly where the SP briefly broke below its 50-day moving average and then it just resumed its uptrend. Technically
Yeah.
it didn't set a new lower low. It just hit the same it hit its November or it's like late November, mid-November bottom. I'm not willing to throw in the towel on being a bull at this point.
No.
I think technically we still look pretty good going into the new year. It does make me wonder if we've maybe accelerated that.
Yes, this was number
The
two on our sort of rundown. Yeah.
so I'll let you go into it because it has been your baby a little bit, but have we just accelerated like our normal
Right.
end of year, beginning of year behaviors?
Yeah, so the market bottom this year came first week of August. Now, there's no set calendar to how the market will behave, but the last few years, the market bottom, especially the last 2 years prior to this one, market bottom came in October. This year is August, and maybe in part due to the election beginning of November, but also due to the Fed's timeline where they started cutting rates in mid-September. It seems like that the timeline was maybe accelerated, 2 months earlier than usual, and maybe that's applying here where we had been talking like maybe don't expect too much broad selling, or at least headline index selling next few weeks, but once we get to January, expect a pullback. Well, it seems like, I mean, it's clearly happening now, um, a month earlier than maybe we expected. So I wonder if that's the impact of the Fed sort of changing the normal timeline. But again, there's no real playbook for these things.
Yeah, yeah. Seasonality is one of those things where it's like there's a lot of different factors that come into play. Um, you know, Taking gains or selling for tax losses where you do it on the calendar matters, but it doesn't necessarily matter as much as protecting your portfolio or protecting the gains that you've got. So I a part of me had been of the opinion that if we were going to get a meaningful correction, it was going to be in response to policies that we saw at the end of January. This feels like profit taking more
Yeah.
than maybe a meaningful correction. I think that my metric will be going into the new year. Do we hit a new all-time high before, say, January 20th? If we hit a new all-time high in like the next 3 weeks, then yeah, bull market is still in effect, and then people are going to be looking for the next sort of macro excuse, and maybe that's policy changes. I don't know.
Yeah.
It's notoriously difficult to work with politicians in investing, as I think Michael Brush can attest.
Yeah. Yeah.
Uh, but yeah, so I don't know. I still think we saw some profit taking and sensitivity. But a big thing I wanted to ask you, did you watch the press conference? Did you watch Powell's press conference?
I missed it, but it sounds like you did and had some. You thought he was a little more fumbling than usual.
It was probably the worst press conference I've ever seen him deliver.
Yep.
He seemed flustered by expected questions. Um, there were questions about why make the rate cut now if they're just going to be slowing it down going into next year. Normally, he's really quick to handle those with, hey, we're data driven, the data supports it. This may change what our sort of what our terminal run rate is for interest rates or what our expectations are, but we're paying attention to the data. And he really seemed caught off guard, and I couldn't get a good sense of why, other than maybe he knew that they shouldn't have been cutting rates. Like you said, the expectations are that they're down to two rate cuts next year.
Yep.
Tyler, who is a Fed watcher like we are, he did not expect a rate cut in this meeting, or I guess he wasn't giving it that 98% chance that the Fed Watch tool had
He has no
had on.
problem going against the the crowd on these Fed predictions.
But I think part of the market's response was to the Fed meeting because the policy announcement was exactly what everybody was expecting, and we
Right.
didn't really see the sell-off begin in earnest until Powell got behind the podium. So I do think that may have spooked the market a little bit. Um, right now, the S&P's bounced today. It's up 1.7%. It's not, it's not quite back to where we were before the meeting, but it's retraced like 40% of its losses. So this feels like it was a little bit more of a shakeout than a real
Yeah.
change in character for the market.
Yeah. And I agree with you that I could see at least S&P and Nasdaq being maybe the Dow, but S&P and Nasdaq at least being to new highs before inauguration day. And after that, who knows? I think there's going to be volatility next year. I'm sticking to. I should probably get out of the prediction business after we got destroyed last week, but I still think the bull market's not going away next year. I still if I had to, we always use my crystal ball is broken here, but yours and mine react like they're working. But
We'll got
I
to use it
still
anyway.
use it anyway. Um, I still think wouldn't be surprised by 10% or maybe a little more bump in the S&P next year. Um, I don't think we're going to see a repeat of what we've seen the last couple of years, 20% plus gains, but I do think we've started a bumpy. We knew a bumpy ride was coming, and it maybe started a little earlier than we thought, a month earlier.
Yeah. Yeah, I think that's fair. And I think the question just becomes, is it, are we hitting speed bumps or are we bottoming out on potholes? And
Right.
right now in the moment, like it's noon Eastern on a Friday, the market is open and trading. It definitely feels more like a speed bump than a major pothole or something that's derailed the market. But
Right.
I mean, we're gonna have to
Unless
wait
the
and see.
government shuts down in 24 hours, or doesn't seem the
12?
market's too concerned about that right now. But
Yeah, yeah. I mean, like we haven't discussed that at all, but
no,
there's always something out there to spook the market. I don't know. I don't have
maybe
any
because there's a
expectations.
history of them taking this to the 11th hour and
Yeah,
then getting a deal done. Maybe that won't happen. But even when they haven't, it's usually resolved pretty quickly. So maybe that's why the market just shrugs it off. Maybe it's not a factor until
yeah,
if we show up here Monday and the government isn't open, then maybe there will be more of an accelerated sell-off again.
yeah. Like obviously, I think market's up 1.7% right now. They're market participants are not sweating it, even if we don't hit the deadline today. All right, well, they work through the weekend and they get something done. It's just become sort of pro forma that these things will get addressed the last possible second. So that doesn't seem to be weighing on anybody. Um, I don't know. I yeah, I don't think I don't even if we get a shutdown, I wonder if that is gonna if that's going to reset market expectations or drive us any lower.
Yeah, we may not know the impact until Monday, and maybe the market will shrug that off too. But we'll see. As I mentioned at the top, just quick programming note: no episode next week, as we're all off for the holidays. Happy holidays, everyone. Brad, you traveling home?
Home,
Home.
brother and family are coming into town. My parents and my wife's parents are already here, so we'll just
Oh,
be driving. We'll be circumnavigating Phoenix for for the 2 days of Christmas Eve and Christmas Day.
yeah.
What about
Yeah,
you?
we have the best of both worlds. We are don't have to travel. We're staying at my wife's parents and my in-laws, which is 2 miles from here, so we don't have to host and we don't have to travel. So
Nice.
that's a good combination. And it's unlike there. We already have snow, and it's supposed to be below zero, uh, below zero wind chills this weekend. So that'll be a nice little um, get you in the mood for the season, I guess. But hopefully by Christmas it'll be slightly less cold than that. Um, let's welcome on our guest, Steve Reitmeister, who is editor-in-chief of Wall Street Zen. All right, we welcome on Steve Reitmeister, who is editor-in-chief of Wall Street Zen, and has been
Yeah.
in the business dating back, I believe, to 99, and economics background as was at Zacks for 19 years.
Yeah.
And you obviously have some thoughts that we read your piece the other day about this market that you think that we are actually it's probably quite it was quite prescient. You wrote this, I think, before the Fed.
Yeah, it was the day before. Yeah, things
Yeah,
got wonky
before
there.
the
Yeah.
cut rates, you said a rolling correction, which will likely become,
Yeah.
a real correction. It almost has. Tell us a little bit about, what you were seeing and what you're still seeing.
Yeah. So the idea of a rolling correction is, if we just think what is a correction, and then that's supposed to be a 10% decline in an individual stock and an index, right? So a rolling correction is if you're taking a look at an index, in the case of the S&P 500, up till the 12/17, right? Up until Tuesday,
Yep.
the S&P 500 was kind of flat on the year, but that was kind of hiding the under the surface pain that was taking place. There was a lot of sector rotation. Small caps were down 4.5%. The equal weighted version of the S&P 500, which says that Foot Locker is as important as Amazon, right? That index was down 3.9%. So this is before the pain that came on Wednesday. So you can kind of see this people pressing the easy button once again with the Mag 7. But besides that, the rest of the market was not looking very healthy. So that's a rolling correction, not that uncommon after a long bull run, right? So the money, people aren't bearish. They just kind of move the money around and the pain gets spread around. Then, yeah, 12/18,
Yeah.
not quite a 9/11 moment, but like it kind of woke people
Yeah.
up. Like, oh, stocks don't always go up. What happened?
Right.
Yeah. And but really, the Fed didn't say anything that was a surprise to anybody. The inflation numbers weren't getting that much better, right? They kind of like froze for the last 4 to 6 months. That I was actually surprised that they did the rate cut, but instead of okay, we'll give you the rate cut, we'll give you the candy that you're asking for, but we're going to give you less candy, less rate cuts
Right.
in the future. Okay, well, six of one, half dozen of the other. So I think it's a spoiled child reaction by traders. Oh, I'm pissed off.
Right.
I'm
Yeah. Yeah.
selling everything.
Yeah.
Okay.
Yeah.
And now 2 days later, the market's bouncing back. There's still value. There's still reasons to be bullish and so on.
Yeah, Brad and I have been hammering the last week or two on here, and some of our other analysts at Cabot.
Yeah.
Obviously the Dow down 10 straight days, which is the longest streak in 50
Mm.
years. That was a
Wow, really?
red
Yeah.
flag there. Yeah,
Yeah.
since 74. Russell is now down. This is up to the minute, so even with today's rally, now down about 8% from its
Yeah.
November highs, and equal weight about 6% from its late November highs. S&P and Nasdaq are more like 3% range, but it's spilled into those indexes. We've talked a little bit about, it seems like the usual timeline, at least from the last few years, has been accelerated a bit this year, whereas past few years you saw an October bottom. This year was an August bottom. And we were wondering if maybe the Fed has changed the normal timeline a bit because they started, cutting rates in September, whereas, you know, October often is the bottom, and January thought maybe that might be when the sell-off started, but now it started this. I don't know what you think about that. Calendar is only means so much, but it seems like the Fed has obviously played a factor in some of the timing here.
Yeah, no, it's let's put it this way. The first 2 years of a bull market, you just pull back to the big picture, they're supposed to be glorious, right?
Right.
You're supposed to bounce from an oversold bottom. So the depth of the bear market was 27, 28%. So yeah, you get all that back and then some. So I think from the valley to the peak of this bull market for the S&P 500 was plus 74%, and that
Yeah.
was in just slightly over 2 years. That's the way it's supposed to be. That's
Right.
glorious. And now's the time to take some profits. Now, I thought it was going to happen in January to kind of delay the tax consequence, right?
Right.
Whatever. Man plans, God laughs, right? So you gotta kind of roll with it that things are going to happen whenever they happen. It is right at this stage of the game to take some profits on the table, to think about, okay, um, what is getting a little ripe, right? Mag 7, right? Large
Mhm.
caps.
Yep.
Where should I be paying attention? Well, if people are logical, that should be small and mid caps, which are actually the PEs are under average, under historical average, well under where the large caps and mega caps are. But whenever you have a sell-off, small and mid caps are going to take more pain, right? So I think that this is a washout that makes way for a more rational 2025, a little more value seeking. The easy money's been made, and then people shifting, I think, a little bit to some of the smaller stocks, not micro, not super aggressive, just healthy, growing small and mid cap stocks is where the action is coming in.
Are
Right.
there any sectors that stand out as having some outsized value to you right now?
Yeah. So it's going to be funny to say it in this moment, but when you pull back to a longer term picture, this makes sense. So what groups are getting pounded? All those groups that were banking on lower rates, home builders, auto, financials, right? Well, rates are still going to go lower. It's just the slope of that change has been altered. So as people are dumping out of those groups, those are still the places to be. As rates ebb lower over the next 2, 3 years, it will lower mortgages. For example, home builders, who, by the way, did pretty good in the high rate environment, are only going to do better, right? So
Right.
home builders, my personal favorite in the group is MHO. So that's one to consider. The banks are still a good place to be, in particular the regional banks, right? So you can round them up with a ETF like KRE, which is getting pounded lately. That's a reason to buy.
Right.
Yeah, auto, income stocks, right? So not super boring, but like growth in income. Let's put it that way. Growth in income is not a bad place to be, as people will be more income seeking as rates go lower. But yeah, that kind of thing.
Now,
And yet, so you take sort of a quantitative approach. You have a quantitative rating system. You did that at Zacks with the Zacks rank model for a couple decades, and since like at WallStreetZen, you have a 115 factor model or Zen rating, which includes AI factors. Talk a little bit about that approach.
Yeah. So let's put it this way. There are literally thousands of factors behind every stock. Everything you can think of, the fundamental space, growth, value, the financials. Then there you got all the sentiment type of stuff, the price action, momentum, charts and things of that nature. You got thousands of data points. And that when you read an article and you say, hey, I'd like to find a good stock, you're not analyzing thousands of data points. You're analyzing like three or four to get that warm feeling. Oh, I like this stock, right? That's not good analysis, right? So the beauty of quantitative research, the reason why over 50% of the trades on the stock market every day, the professionals love it because the computers can do so much more heavy lifting to find out what are the factors that actually make a difference in our analysis. Only 115 factors point to outperformance. The other 2,000 are worthless, right? So focusing in on those 21 factors of growth, 26 factors of um, financial health, ROE, ROA, and then just keep coming down the list. You got value, you got momentum, you got the AI factors, and so on. So a really 360-degree view of a stock by the computers, and from this refined list to take a look at just the top 5%, right? So narrowing down that world, top 5%, those stocks, that smaller group of stocks, providing a 32.52% annual return going back to 2023, meaning it does drill down to the best stocks and also shows you the stocks to stay away from, the stocks that go down even in bull markets, right? So that's the beauty of a really complete and well thought out quant model like we have at WallStreetZen.
Yeah, I was going to cite that stat. 32.5% average annual return in the last 20 years, basically, which is
Yeah.
triple the S&P performance. So that's pretty strong performance
Yeah.
and pretty good advertisement for how the
Thank you.
quantitative approach
If,
works. Brad, sorry, go ahead. See.
Yeah, I was gonna say if I could just drill into one thing, right? So everyone's talking about AI, right? So yeah, AI is part of this, and it's something that the data analytics firm we were working with had been trying to dial in for 2 years and added to this model. So we can use all kind of fancy jargon, but I'll just say this: it works, right? So without the AI factor, it's a 28% annual return. With the AI factor, it's a 32.5% return, meaning that extra alpha. And so what is AI good at? AI is good at seeing relationships of stocks. What did they look like before they went up? And then using that knowledge to try and find similar looking stocks, and so it really is excellent for timeliness, right? So if you're looking for timely stocks, the AI factor is really great at dialing that in and upping the alpha on those picks.
Will leveraging the AI factor uh, lend out performance to something that might not have your like the strong buy? So given the timeliness of it, is it gonna or does it have the potential to pull something that might only be buy rated up to like the performance caliber of something that's more like a strong buy? I'm curious
Yeah.
how I guess how momentum weighted it is.
Yeah. So I would say that the model overall, I've worked with a number of models over the years. The previous one I worked with had a little bit more of a value bias. I'd say this model is a little bit more of a momentum bias. So the combination of the AI and I think there's 22 factors of momentum, right? Price action that are involved. It's much more dialed into timeliness. But we caution people that like, hey, there's a reason why we analyze 115 different factors. You got to start there. It's kind of like, don't pass go, don't collect $200, in Monopoly. It needs to be A or B overall, meaning to be in the top 20% of stocks based upon 115 factors. Now, if that is true, now let me look at what the AI factors, if the AI sounds like it's important to me, want really timely stocks, then trying to find A and B rated AI stocks
Mhm.
inside that universe of the best overall stocks. That's the way we wouldn't just jump straight into the AI grade and pay no attention
Sure.
to the overall. Yeah.
Now, to get I guess my question is sort of about portfolio size, right? So, obviously, if you're saying, okay, this is the A-rated stock in the sector I like with the AI rating, you're not advocating somebody just pile their entire portfolio into it
No.
because there's too much outside risk of unexpected events or what have you. What sort of portfolio size are you guys in general recommending to replicate those 32% annual returns or
Yeah. So, okay. So the 32% returns is based upon the entire universe
Sure.
of all A-rated stocks, right? So about 4,600 are being computed, 5% are A-rated. That's about 230
A-rated.
stocks at any given moment, right? And what it does is it has a 4-week rebalancing period, meaning it takes a look on the first Monday of the month, right? Kind of like that, buys all the stocks, holds it for 4 weeks, doesn't even look at what's going on, doesn't look at changes in ratings, and then 4 weeks later gets rid of things that are no longer A, adds in the new ones, rebalances, and so on. So that's where the 32% return comes from, which gets rid of some of the extra noise that happens in a rating system that's updated every day. Now, that's the entire system. No one's doing that. No one's
Right.
buying 230 stocks. I would say that 10 to 20 stocks is what an investor should do. Most investors, when studies are done, own 3 to 5 stocks. That's where most of them are at. That's not enough diversification. That's not good enough when one of them has a bad earnings report and goes down 20, 30%. That's too much of your net worth going down the toilet. 10 to 20 stocks is a much better place to be, and so therefore using resources like this to find good ideas, and then you keep narrowing down from there to find the ones that work for you. Then again, we have other services like my Zen Investor portfolio, where I put in the extra hours, I do all the research, I spend my time when I should be watching the Chicago Bears, no reason to watch them.
Oh man.
That's when I'm picking stocks,
Uh-huh.
right? And then narrowing it down. So my Zen Investor portfolio has 16 stocks in it. That's meant to be a much better starting point for somebody's analysis, but that's me putting in the extra hours. Yeah.
Brad's an Arizona Cardinals fan, so he can relate to your pain. Just in warmer pain, I guess.
Yes, Bomber Bay.
Uh, what last thing I wanted to ask was, we've talked a lot about the last few weeks what we're expecting for 2025. What do you expect from the market next year?
Yeah. The historical pattern, and we talked a little bit about the front end of that. The first 2 years of bull market are supposed to be glorious, big gains, and then the third year is kind of sleepy, right?
Yeah.
So let's just say 0 ± 5%, right? So kind of a mundane year, but that's for the indices like the S&P 500. And when you take a look at the PE, the forward-looking PE, which is 22, 23, that's pretty fully valued. So it is a good time to rest and then find value elsewhere. Now, if we're talking about the Russell 2000, the
Mhm.
small cap stocks, that index is only up 40%. Actually, sorry, that number's as of Friday. It's like 32%, right?
Right.
Only 30 up 32% from bottom, half as much gain as the S&P 500. This is where the value is. I would not be surprised to see the small caps up 10 to 20% this year as a group, right? So this is where my focus is. I don't mean micro cap. I mean 1 billion, $2 billion, probably up to about $10 billion with mid caps as well. This is where the focus should be, where I think people can find healthy growing companies at reasonable valuations.
Yeah, we've been hammering or sounding the horn on small caps for a while.
Yeah,
Eventually you keep saying it, eventually you'll be right. And it has had a nice few months here, but I
yeah.
totally agree that small caps seems like they're due to outperform next year, which it's been a while.
It's
Uh,
it's the logical answer. The
right,
market's not
Yeah.
always logical, right? But
right.
any rational human being taking a look at the value, taking a look at small caps underperforming for 4 years relative to large caps, that reversion to the mean, right? That sanity needs to be restored, and small caps have their time in the sun.
Brad, any further questions for Steve?
I'm gonna I don't know. Crypto. I want to get your take on it. You're a macro guy. I've read a number of pieces. I assume that you're out on it entirely, but
You bet.
I'm here to be surprised potentially. So I'm curious where you're at with that. I know it's not
Yeah,
there's no earnings projection on crypto, but it's become such a big piece of the investing public that
yeah.
I'm curious
So,
what your take is.
so I am going to shock you. I took one of my IRA accounts with enough money. Yeah, if it all blew up, it wouldn't make any difference in my life. I just didn't want to be the guy who said he didn't have anything in it, right?
Yeah.
So I bought it when I was about 62,000 for Bitcoin. Okay. So, okay, great,
Yeah.
whatever. Right. There is no fundamentals. I appreciate the underlying principle of why it exists, but money is supposed to be stable. This is not stable. It's
Right.
not supposed to be speculative, right? And so therefore I have no idea what it's worth. So that's why it's a speculative bet on my part to have it. I have no here again, was it worth? Who knows what the next fool will pay for it.
Sure.
Right. And yeah, so I was one of the fools who said, okay, yeah, sure, like here's a little money. But should it be more than 10% of someone's portfolio? Absolutely not.
Yeah. Yeah. We've
Wise
talked about
advice.
it.
Yeah.
Yeah, it's great advice. We've talked about it as just almost purely a bull market tool.
Yeah.
And yeah, over 100,000 now seems, like it might be on borrowed time, although I'm just pulled back a little bit the last few days, but totally agree with you there. Um,
Who knows?
so
Yeah.
yeah, Brad, go ahead.
No,
No,
that was me. Yeah, that was me.
Oh, sorry. So if you want to sign up for Steve's newsletter at wallstreetzen.com, we have a deal today. If you go to cabotwealth.com/street, you can just put in your email and you get a free and immediate access to Steve's new stock of the week picks on wallstreetzen.com. Plus, you'll be alerted each week as his next top stock is revealed. So again, go to cabotwealth.com/street. We'll have a place where you can click on that on the YouTube channel. And you can sign up for free to get Steve's stock of the week picks at wallstreetzen.com. Steve, thanks for joining us. This was really, really fun. And it's really interesting to hear different perspectives. And yours is really unique. And obviously it works. So thanks for joining us.
Thanks,
Yeah.
guys.
Thanks.
Thanks, Mr. Brad. Take care,
Thank you.
guys.
And happy. It's okay, Madison. Well, we can do that again at the end. But
Yeah.
thanks.
All right,
For
boys.
joining us. And yeah, happy holidays. And you're welcome back anytime.
Yeah, I was
We're
gonna
good.
say, yeah, I'm happy to do this, or even on short notice, you got a spot that somebody crapped out on. I'm happy to hop in and help you guys out. But yeah, always fun.
Awesome. All
All
right.
right. Thank you.
Thanks. Have a good one.